MBA ASAP. MBA ASAP. Hello and welcome to another episode of MBA ASAP, where we explore business skills and knowledge so you can level up your expertise and learn skill sets that will make you more valuable at your job and career, or help you start something on the side, a little side hustle, or let you quit your job and start your own business. I'm your host, John Cousins. Let's get started. Hi, I'm John Cousins, and welcome to the podcast. Today we're going to talk about net present value, or NPV for short. In the last episode, we talked about the time value of money and discounting cash flows. Now, with the net present value, we're going to take those two concepts and turn them into the gold standard analytic tool of finance, NPV. Now, what net present value does is take a stream of cash flows going into the future, discount them back to the present value, so we have a value for all of the future cash flows that we're expecting, and then compares that to the cost in today's dollars of what we're going to have to pay to get those cash flows. And that may be an income-producing asset, like, say, a stock or a bond, or something that we have to purchase in order to get those anticipated future cash flows. Or it may be a project that we're thinking about developing, and we look at what are the future cash flows that we're anticipating getting, and then how much is it going to cost us to make that project. And we talked a little bit about that in the last episode. I gave the example of a power plant. If we were going to build a power plant, it was going to cost us $1 billion to build the power plant, and the present value of the future cash flows were $1.5 billion, then it would be a good deal. If the present value of the future cash flows was $900 million and it was going to cost $1 billion to make, then we would decide not to do that project. And when I say the anticipated cash flows, what I'm talking about are we really don't know in the future what the cash flows are going to be. We make forecasting assumptions about what we think they're going to be, and we can get pretty sophisticated in doing that. But as we all know, whatever we plan for the future is probably most likely not going to be the outcome. It may be more, it may be less. It may be more of a success than we anticipated, or it may be more of a failure than we anticipated. The way that we calculate in that type of uncertainty is with a risk premium. So we'd put a risk premium on our discount rate as we're discounting back those future cash flows in order to take into account that risk and that uncertainty. So the other two things that will affect the present value of those cash flows is, one, we just talked about the discount rate. The more we discount things back, the less they're worth in present value terms. The less we discount them, the more they're worth in present value terms. So the higher the discount rate, the lower the present value. The lower the discount rate, the higher the present value. It's an inverse relationship between the risk premium, the discount rate, and the present value. The other two things that we need to take into account are obviously the size of the cash flows. The bigger the cash flows are, the more the present value is going to be, and also how far out in the future they are. The further out they are, the more they get discounted. The closer in they are, the less they get discounted. So that horizon to revenues is the third critical component, the third driver of the present value side of net present value. The other side of net present value would be the costs. If it's a project that we're contemplating doing, then we have an idea about what those project costs are. But as we all know, projects tend to have cost overruns. It's rare that a project comes in on time and on budget. So as a project is delayed and takes more time, and as there's cost overruns, we may have anticipated that a project was going to cost X, and it may end up costing X plus some premium for unknowns that we didn't understand. So a lot of times we want to put some sort of contingencies into the budgeting and forecasting for the costs if it's a project that we're doing. If it's an asset that we're actually going to buy, then it might be a negotiated price, and we know what the cost is for those cash flows in the future. And if it's a structured investment, like a bond or a debt, then we know exactly what those incomes in the future are going to be. The only risk there is if there's a default on that bond and then we don't receive those monies. But the bond payment is supposed to be $100, then that bond payment will be $100. There's no guessing that maybe sales will be more or less, and so the income could be higher and lower than what we were anticipating. So there's those kind of differences in the projects that get analyzed using net present value. But you can see in essence, it's what's it going to cost today and what are we anticipating getting in the future. And if what we're going to get in the future is worth more than what we have to pay for it, then we green light that deal. That's a deal worth doing. And that's a function of, as we said, the discount rate, when those payments are timed to come in, and how much those payments are. So let's go to the segment here and explore net present value in a little more detail. I'll catch you on the other side. Net present value. Now that we have gone over the conceptual basis of corporate finance, we are going to look at the main techniques and tools used in financial analysis and decision making. In business, we invest in projects that make money in the future. We pay now and intend to reap the rewards in the future. Usually, a project or asset will make money as a stream of revenues and profits over years. It could also be a project whose main benefit is savings. We need the ability to calculate whether that stream of future cash flows is worth more than the money we need to invest to buy it or to build it. The way we look at decisions about whether to fund a project or calculate the value of an asset is to turn that stream of future dollars into today's dollars. Then we compare that sum of present values to the cost. If the cost is more than the total present value, we don't do the deal. If it's less, it's considered a good deal. This is the way projects are analyzed and assessed as go or no-go, and how income-producing assets and acquisitions are valued for sale or purchase. So far, we have analyzed and calculated the value of future cash flows and brought them back to the present value. Now, net present value, NPV, takes this idea a step further and accounts for the transactional aspect. We must purchase the future cash flows by either buying a bond or stock, acquiring a company, purchasing an income-producing asset, or undertaking a project and incurring the costs of developing or building that income-producing asset. Net present value nets out the cost of acquiring the future cash flows. NPV compares the cost in today's dollars to the present value of the projected income or benefits also in today's dollars. It's only worth doing if the price is less than our assessment of the future benefits. NPV is the main tool used to value assets and make decisions about projects, purchases, mergers, or acquisitions. The spreadsheets can get pretty complicated when they are populated with all the costs, revenues, and expense projections, and the assumptions about the timing and the risk. But the basic idea is always to compare the costs to the future benefits and compare them apples to apples by taking into account the time value of money. NPV answers a simple question. Does the present value of all the money coming in over the life of the project outweigh how much money we have to spend in order to receive it? Net present value is just that. It's the net between the present value of these two streams, the money going in and the money coming out. We ask whether NPV is greater than zero. If it's greater than zero, then the costs are less than the benefits, and we should do the project or make the investment. That's our decision rule. Is the NPV bigger than zero? We can construct a formula for NPV by following along very closely with what we did in our discounting cash flows. The NPV is equal to the initial cost, which has a minus sign in front of it, plus the present value of what's coming in off the project as cash flows. Cash flow in period 1, discounted back 1 period, plus the cash flow in period 2, discounted back 2 periods. The cash flow in period 3, discounted back 3 periods. You get the idea. Plus all the other cash flows coming in by their period. What we do is take that initial cost and weigh that against the present value of all the cash coming in. We're going to net the two. There's a minus sign on the costs and plus signs on all the present value cash flows coming in. We ask how all the money going out weighs against all the money coming in. Think of it like a balance. If we know the initial investment and the stream of money coming in from the project in the future, we can measure the NPV as the difference between the two, the net between these two streams. As the initial investment becomes larger, the NPV becomes smaller. You can see that the NPV, whether it's bigger than 0 or less than 0, depends on the balance between the money going out and the money coming in. Let's work a problem and compute an NPV in practice. So now we're going to calculate an NPV. Here is the example. It is a stream of cash with a cost today in year 0 of $3,000, and then we're expected to get $1,500 in year 1, $1,800 in year 2. So let's think about whether it's worth doing this project. In period 0, today, we need to spend $3,000. Is it worth it to spend that $3,000? What do we get in return? What are the cash flows coming in off the project? Well, we have a cash flow of $1,500 coming in at the end of year 1, and we've got a cash flow of $1,800 coming in at the end of year 2. If we just sum up those cash flows, it's a minus $3,000 because it's a cost, right? So there's a minus in front of that, plus the $1,500 coming in year 1 and the $1,800 coming in year 2. If we add all those together, we get $3,000 minus $3,300, the $1,500 plus the $1,800. The net answer is $300 positive, right? This project is generating cash. It's profitable. The money coming in is bigger than the money going out. That's the sum of all cash flows, but that's without any discounting. We haven't accounted for the fact that we have to wait a year to get the $1,500 and wait 2 years to get the $1,800. So it doesn't take account of the time value of money. Remember, to use money, you have to pay. There's a cost of capital. So what do we have to pay? Well, in this case, we assume we have to pay 15% as the discount rate. That is the cost of capital in this example. So when we look at it that way, we take what comes in year 1, right, $1,500, and divide it by 1 plus the interest rate, which is 0.15, 15%, to the first power, because it's in the first year. That comes out to be $1,304. In year 2, the $1,800 would be, for the present value, $1,800 divided by 1.15, that's 1 plus the interest rate of 15%, right, to the second power, squared. That number comes out to be $1,361. So now the money coming in, expected in present value at 15%, is less than the $3,000 by $334. So suddenly it doesn't look like such a good project, right? We need to adjust the cash flows for the time value of money by discounting them back to the present value. We take that $1,500 and discount it 1 period at 15%, and we get $1,304.35 to be exact. Then we take that $1,800 and discount it 2 periods at 15%, and we get $1,361.06. Now when we sum those present values together with all those cash flows, we get a minus $334.59, which tells us that the project destroys value. It's not worth doing. It's a profitable project, but we don't want to do it. Why would we ever not want to do a project that's profitable? It all comes down to the 15% discount rate. That 15% indicates what the hurdle rate is for the profitability of the project. This project might be profitable, but it's not profitable enough to justify the required 15% return. If our investors require a 15% return to take the risk of this project, we're not going to be able to deliver it to them with a project like this. We can't deliver that kind of return. So let's examine some of the main drivers in the present value calculation. First is cash flow. Obviously, more cash is better than less. The second is timing. The further the cash flow is out in the future, the deeper it gets discounted. The third driver is the discount rate. The higher the discount rate, the deeper the cash flows get discounted and the lower the NPV. The lower the discount rate, the less discounting, and the better the project looks. Lower discount rates, higher NPV. Higher discount rates, lower NPV. Net present value is the benchmark metric. It is our best capital budgeting tool. It incorporates the timing of cash flows. It incorporates the opportunity cost because that discount rate quantifies, in essence, what else we could do with that money. The fact that we're discounting implicitly incorporates the opportunity cost, and it incorporates risk. If we think the project is a lot riskier, what can we do? We can increase the discount rate to reflect that risk. NPV is objective in the sense that if we have good forecasting and good discount rates, accurate discount rates, we can lay this out and calculate it in a way that is presentable and explain it to anybody. It's an arm's length metric. NPV is transparent. We could sit down together with a spreadsheet and go over it and explain all the assumptions to each other. Net present value weighs the costs and benefits of cash coming in versus cash going out and gives us an objective, arm's length, and transparent metric for capital budgeting. It's a great tool. So let's remember, the main drivers of NPV are cash flow. More cash is better than less. The timing. The further out the cash flow is out in the future, the deeper it gets discounted. And the discount rate. The higher the discount rate, the deeper the cash flows get discounted, and the lower the NPV. The lower the discount rate, the less discounting, the better the project. Remember, lower discount rates, higher NPV. Higher discount rates, lower NPV. Well, that's it for this episode. Thanks for listening. The show notes are available on the website. Just go to nba-asap.com and click on Podcast on the menu along the top, and there you'll find all things related to the podcast. Just scroll down and there are links to the show notes for each episode. If you have any questions or suggestions, email me at john.cousins@nba-asap.com and follow me on Twitter. I'm very active there. My handle is @JJCousins. And send me a connect request on LinkedIn. I'd love to connect with you there. And go to the website and sign up for the mailing list. Thanks again. Until next time, peace. NBA ASAP. MPA ASAP.